Hi and welcome back. In this video, we will learn more about the days methodology, which is used to represent some balance sheet items. The days calculation indicates how many days are necessary in order to cash receivables, pay trade payables, or that an item leaves the warehouse of the firm. Days sales outstanding, DSO, days payable outstanding, DPO, and days inventory outstanding, DIO, are working capital components. DSO is a measure of the average number of days that a company takes to collect revenue after a sale has been made. A low DSO number means that a company needs fewer days in order to collect its accounts receivables. A high DSO number shows that a firm is selling its products to customers on credit and taking longer to collect money. DPO is a company's average payable period. Days payable outstanding tells how long does it take for a company to pay its invoices from trade creditors such as suppliers. DIO is a financial measure of a company's performance that gives investors an idea of how long it takes a company to turn its inventory into sales.